We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome into Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us today. Hey, I would encourage you to check out Brian's website, DeckerRetirementPlanning.com, DeckerRetirementPlanning.com. There's a lot of great information about the company, what they do, and of course the great team that Brian has assembled to help his clients retire to the best situation they can. And of course, we always tell you when you go to DeckerRetirementPlanning.com, there are a lot of things you can download. There's like 12 different things you can download, and it's really there for your information. There's no cost for this. There's no obligation whatsoever. But you can get Brian's book on retirement, The Decker Approach, 3 Principles of Retirement Book, Checklist Challenge, Sample Income Plan. Those are 4 of the 12 things you can download, but it's really there for your information. Again, that's DeckerRetirementPlanning.com, and that is under the education tab on that website. If you have any questions, hey, can I retire? Well, when can I retire? Am I going to be okay if we retire? Are we going to be okay if we retire? 833-707-3030, 833-707-3030. All right, we're going to kind of go back in time. So Brian's been in the financial world since 1986. He was a broker for a while, got into the part of building plans for retirees in 2002. And we're going to talk about that, kind of the philosophy of Decker Retirement Planning. Welcome, Brian. Looking forward to our conversation today.
Mark, we're going to cover a lot of ground today, and listeners are going to be wanting to write some notes on some of the things that we'll cover.
Really? Taking notes today?
Yes, it's that important.
Okay.
And Mark, let's start off with some of the firms. I would say, and Mark, you chime in here, you tell me your thoughts, but I would say the most important decisions people make at retirement is what kind of advisor they go with. Do they go with an advisor that's compensated on commissions, or do they use a fiduciary? I would say that's their most important decision. And I want to spend a few minutes on fiduciary because the definition of fiduciary is someone who is required by federal law to put the client's best interest before the company's best interest. And one of the things that makes us different as a firm is we have plaques in our office that our motto is do the right thing for the client. And that's really served us well, and it's attracted clients, and they've commented on it as something that they've seen as a difference. Let me give you a little factoid, Mark. About 25% of the people who come here, we review their situation and we close our binder and say, you're in great shape. We wouldn't change anything. And we send them on their way. Do you know that's a quick way to get fired if you're compensated by commissions?
Yeah, that would make sense because that company has to get clients to make money. So I mean, you're looking at it a little bit differently. That's probably where the fiduciary standard comes in, because you can't tell them, hey, we can really help you when they don't really need your help.
Correct.
Yeah.
And another thing is we're a math-based firm, and clients like that too, because instead of giving quote unquote opinions, we show them the logic mathematically. But I want to stay on this fiduciary topic because many advisors will tell their clients that they are fiduciaries when they're not. And so rather than call them out, we will give everyone 3 critical points that have to be in place for them to be a true fiduciary. Number 1, they've got to be independent. And this is common sense. So Mark, if you're with Fidelity, guess what kind of mutual funds you get?
Fidelity.
If you're with Vanguard, guess what mutual funds you get?
Vanguard.
And Merrill Lynch?
Merrill Lynch.
That's right. So that's not necessarily in the best interest of the client. And so one of the things is to be independent and make sure that the client can have an advisor that can see all the different tools that are out there and free to use all the different tools that are out there. So number 1 is the advisor needs to be independent. Number 2 is they need to be an RIA structure, Registered Investment Advisory. As a registered investment advisory, that means we didn't swerve into that on accident. Mark, we set our firm up so that we are fee-based. That means that we cannot take commissions and be compensated by security commissions. And so that's another key point. That's number 2. Okay, Mark, the third and final thing to be a true fiduciary is to have a Series 65 securities license, not a Series 7. A Series 65 securities license means you cannot take any security commissions. You've got to be fee-based. And clients like that. They want to be fee-based. Everything has to be above board. So let me give you a few examples of how non-fiduciaries day in and day out take advantage of retirees. So consider this a community service for these next few minutes of telling people to beware of certain things. So the first thing is a variable annuity. Variable annuity that has security commissions. That's a product that is often used with non-fiduciary advisors, Series 7 licensed advisors, not Series 65. And that's where the broker or the advisor gets paid about 7-8% in commissions right up front, comes out of your money. They get paid every year you own it. The insurance companies get paid every year you own it. And the mutual fund companies get paid every year you own it. 3 layers of fees that usually add up to, 5-6% per year in fees before you start making money each year. So we want to warn people we don't like variable annuities. We don't see any use of them in anyone's retirement plan because we can easily use other tools that are far less costly and have a much better bang for our buck. There's no downside protection in variable annuities. Why not buy the S&P, SPY, pay no fees or little to no fees, and have much more performance? And we can buy it in an IRA and you still have the benefit of tax deferred growth. It just makes no sense to us to have a variable annuity. That's example number 1. Example number 2, Mark, is when someone sells you a non-traded REIT, real estate investment trust. A real estate investment trust is where it's non-traded because the banker or broker, the advisor, usually gets paid 10 to 12% right up front. That comes out of your principal. That's why they don't show you the value of your investment for usually about 5 years, and then the window becomes open. They need that period to regain what's gone out in fees. So we don't like them. They're not liquid. The returns for REITs can do well, but there can be period like 2008 where real estate, the average REIT in 2008 was down 70%. So we don't really like non-traded REITs. We would much rather buy the real estate investment trust ETF, very little fees. It's totally liquid and it tracks with all different kinds of real estate, any kind that you want. And the third example I want to give you, and this is horrible, Mark, this is where you tell your advisor you don't want, with your mutual fund purchase, you don't want any upfront fees, back-end fees. So they say, yes, sir, yes, ma'am. And then they go ahead and with no disclosure, they attach a 12B1 fee that doubles your fees from 1% to 2% on that mutual fund. No disclosure. Those are called C as in Charlie, C share mutual funds. You can look at your statement and see if you have these because it will say that on your statement. XYZ mutual fund dash C shares. If you have C shares, you should have a conversation with your advisor why they didn't tell you that they doubled their fees. Oh, Mark, I just thought of one more. Here's another example. This is the worst, I think. This is so slimy. It's a bait and switch type of thing, Mark, where an advisor will tell you, hey, Mark, do you want to get 7% guaranteed for 10 years and then 4% for life? That sounds pretty good, doesn't it?
Does sound good, yes.
Okay. So let's say you put 200,000 in. This is easy math. And in 10 years, so you're 65 years old, you retire, 7% doubles, your 200,000 doubles to 400,000. So 400,000, and then at 75, you get 4% for life. So 4% of 400,000 is 16,000 a year. Well, guess what? How long does it take for 16,000 to pay back your original investment of 200,000? And the answer is 12 and a half years. So now you're 75. You need to live to be 87 and a half years old before you start to get your money back on that investment. You have a zero return for all of those years, 65 to 87 and a half.
But I thought I already doubled it. I went from 200 to 400 in the first 10 years, didn't I?
No, for you to get your original 200,000 back, you have to wait till 87 because your investment has back-end fees that you can't access that money. It's accessed through paying you back. And so when you pay that back, you're paid back 4% per year.
So there's a time frame before I really start getting
Correct.
in there. Yes.
Yep. It's through income. So you have to live to be 87 and a half years old. That's 22 and a half years with a zero rate of return. We don't like those investments. We don't use them. We don't use variable annuities, income annuities, life annuities, or income riders in our retirement planning because we are fiduciaries and because we are math-based. So back to my original point, Mark, I would say that when people retire, their most important decision is, do they work with a fiduciary or not? I would say that's their most important decision. Oh, one more thing. Mark, some people say that they're duly licensed. They have a Series 7 and a Series 65. Well, that's great. But how do you know as the client, how do you know when they're talking to you as a fiduciary or when they're talking to you as a commission-based advisor? You don't know that.
So duly licensed to me is you work, that you can help, Decker Retirement can help people in the market, certainly. Operate under the fiduciary standard there. But in the insurance side of things, whether it's annuities or life insurance or what have you, now we're in the suitability standard. That's different, isn't it?
Yes. So so securities, you hopefully will make the right choice and deal with a fiduciary. On the insurance side, suitability standards are important across the board. Suitability means that you can't have someone that has liquidity of, 700,000 and tie it all up in an annuity. You can't do that. That's a breach of fiduciary standards based on liquidity. There's fiduciary standards based on investment experience, on risk, on time, on liquidity, on age. Those are all key suitability points.
So really, when you think about it, when you're thinking about retirement, maybe you're in your 50s and you're like, you know what, I'd like to retire at 60. Or maybe you're 58 and you're like, you know what, my goal is to retire at 58. Or I'm 62 and I think, you know what, I'm going to work till 70. I'm going to maximize Social Security. I think that's my best play. The idea is, why wouldn't you sit down with a team that actually works in the retirement world like Decker Retirement Planning? It's right there. Decker Retirement Planning. They're helping you figure out your strategy. What do you need? The Decker approach has a lot of action there because it's a safer retirement focusing on income planning and distribution planning, because you can't retire if you don't have income. So you've got to figure out, where's the income going to come to replace the paychecks. You sit down with a team like Brian has created at Decker Retirement, and you think about that fiduciary standard. Again, the three keys to that: independent, which means they're not working for a company, Vanguard, Merrill Lynch, whoever, but they're not working for a company, Edward Jones, whoever, right? They're working for Brian Decker, and he's working for you. So independent advisor, then they have their own RIA, registered investment advisor, and then Series 65 license, not Series 7 or all those other ones. It's a Series 65, which means they're not taking, they're not charging you, they're not getting commissions off the market from you. So there's a lot of moving parts here. I think at the end of the day, just know that fiduciary standard means that Brian and his advisors are morally, legally, ethically obligated to do what is in the client's best interest. That's really a key. If you'd like to sit down and chat with them, 833-707-3030. No cost to you, no obligation, no pressure either. 833-707-3030. And as Brian said, 25% of the time they sit down with people, they say, man, you've done a great job. Just keep doing it. You don't need us. Keep doing it. You've already won the game. That would be great to know. But if we needed to make some changes, wouldn't we like to know that as well? 833-707-3030. We're talking about some of the challenges in the retirement world, especially if you don't actually work with somebody that actually works in the retirement world. More with Brian J. Decker right after this. This is Safer Retirement Radio.
If you only think about taxes once a year, you're doing it wrong. To get the most out of your retirement nest egg, you shouldn't just file your taxes. You need to plan for them. Call Brian now to see what tax opportunities you could take advantage of. 833-707-3030. 3030. That's 833-707-3030. Decker Retirement Planning has a question for you. Is your retirement inflation-proofed? Here's what we mean. In retirement, chances are you're on a fixed income with variable expenses. So how do you not run out of money when the cost of just about everything continues to go up? You inflation-proof it. Brian Decker and the team at Decker Retirement Planning can show you strategies to help combat inflation so it doesn't outpace your retirement income. Call Brian Decker today at 833-707-3030 to learn more. Inflation could take a huge chunk out of your retirement savings, but it doesn't have to. With some simple planning, inflation can go from being a major disruption to a minor annoyance. Call Brian and the team at Decker Retirement Planning now to start inflation-proofing your retirement today at 833-707-3030. 833-707-3030. Investing involves risk. Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Again, you can always learn more on the website, DeckerRetirementPlanning.com. There's a lot of information there as well for you that there's no cost to you. It is under the heading of Safer Retirement Education, 12 different things you can download, including Brian's book on retirement, The Decker Approach, DeckerRetirementPlanning.com. We're talking about the importance of actually, when you get to retirement, and really before you get into retirement, actually sitting down and chatting with a retirement planning team like Decker Retirement. So we're talking about what happens when you call that number, 833-707-3030. What happens when you call the team? There's a lot of things they're going to go through. And so we started with the fiduciary standard, morally, legally, ethically obligated to do what is in the client's best interest. There's keys to that, right? They got to be independent. They can't be captive. Captive means they work for Fidelity, Merrill Lynch, Edward Jones, whatever. They're working for a company. That is not the case. If they're independent, and that's what Decker Retirement is, independent. They can work with all these different insurance companies, all the things that are available on the security side as well. It's about you, and that's really one of the big keys to this. So there's a lot of things going on. So we know that you've started really working with retirees. You've been in the financial world, Brian, since 1986. But you really started working with retirees, kind of your focus on retirees and creating plans for them to make sure that they would be okay. What a great time to start it, right after 9/11. And we've got the dot-com bubble bursting, and then you go to the Great Recession. There were some challenging times, I would think, when you're creating retirement plans, because market headwinds play a role in this. And we know people that are, holy cow, Brian, the market just went down like crazy. I've got to go. I got to get to cash. I can't afford to lose any more money. There's a plan about that. That's certainly something you talk about, I'm sure.
Yep. Okay. So Mark, so we talked about the fiduciary side. Now let's talk about some of the headwinds in retirement. Retiring right now is very difficult. I'm going to point out some things that weren't true 10 years ago, Mark. Let's first talk about interest rates. So from 1940, the 10-year Treasury was at 2%. In 1980, 40 years later, interest rates had risen to almost 15% on the 10-year Treasury. 40 years of rising interest rates. And then, just like clockwork, from 1980 at 10-year at 15%, 40 years later, 2020, August of 2020 to be exact, we bottomed on the 10-year at 0.47%. 0.47%. Anyone who is advising clients to stay in bond funds when interest rates are that low is committing, in our opinion, financial malpractice, because interest rates almost at zero, two problems with that. You're almost getting paid nothing. And number two, when interest rates go up, and by the way, we've been saying this for a long time, when interest rates go up, you lose money. So Mark, not just a little bit of money, but in the last 3 years, the average bond fund is down almost 30%. So,
well, wait, bonds are safe.
Yeah, bonds are safe. So individual bonds and CDs, if you hold them to maturities, have no interest rate risk. They accrete to par, and so you're right.
But I think what happened was 2022 showed everybody that bonds aren't as safe and never really in danger because we learned that in 2022.
Bond funds. So we're specifically talking about bond funds.
Okay.
So from 2020, August of 2020 to present, the average bond fund is down in fact, over 30% in the last 3 years. So we want to warn people that in a rising interest rate environment, you lose money. Your money is not safe in bond funds in a rising interest rate environment. So there are better options. We'll cover that, or we have covered that in other radio shows that we've done. But we want to warn you in a rising interest rate environment to not have your money in bond funds, point one. Point two is now the stock market has changed. What has worked in the last 15 years probably, actually historically speaking, will not work in the next 15 years. Let me give you the data. There's been 4 times that the S&P has traded above 30 times trailing earnings. That's a valuation level. One was 1929. It took 17 years to get your money back, to get what you invested back. 17 years. The second time was 1964. It took 18 years to get your money back. Third time was November of 1999. It took 14 years to get your money back. Fourth time was November of 2021. We hit 32 times trailing earnings. And if history repeats, and I believe it will, we're looking at the next 10 to 15 years of flat stock market returns. That means that passive investment strategies will make nothing. That means passive means buying and holding your mutual funds, ETFs, individual stocks, will earn nothing if history repeats. So we want to make sure, and by the way, Mark, think how devastating that would be. We're a math-based firm, how devastating that would be for someone in retirement to be drawing from a portfolio that hasn't made money in 15 years. That will send millions of retirees back to work. So we have a solution for that. We'll get to that in a little bit. Well, I'll just tell you right now, active management is going to be critically important. Not just critically important, it'll be the only way. I hate to use superlatives like only, but historically speaking, it's the only way to consistently make money is to have active equity management on your risk funds during the next 10 to 15 years. That is going to be key. So anyone recommending you buy and hold in this environment is not helping you. Anyone that is telling you to put your safe money in bond funds is also not helping you. But here's strike 3, Mark. Strike 3 is we have a higher interest rate environment, inflation. We'll talk about inflation in a second, but people are living longer. And so now we have to have your money last longer in a lower interest rate environment, which is a rising interest rate environment, and a flat market cycle where your money's not earning much, if any, and then you're living longer. That is a really tough combination. Now, we've got solutions for all of it, but that's what you're looking at. And I'm going to say this one last time, so if you are taking notes, you can write this down. 3 key problems in retirement right now. One is rising interest rate environment means that your bond funds will hurt you. Number 2, buying and holding in a flat market cycle like we are projected to be in means passive buy and hold on stocks, mutual funds, ETFs are not going to earn much of anything either. We're living longer, that's point 3, but there needs to be a solution for high inflation. So Mark, in 2 minutes, I'm going to bang this out. High inflation, we have 5 key parts to our solution on inflation. Number 1, we build in COLAs, cost of living adjustments, in our planning so that our clients get a little more income each year. That's one part of our solution. Number 2, our clients, we price in any inheritance that they're getting. Number 3, we make sure that our clients know that their real estate is a hard asset that benefits them in an inflationary period. We are not saying to get a reverse mortgage. We are saying that if you had to, you could get a HELOC and you could tap into that if you need it. It acts as an inflation hedge. Number 4 is the risk bucket that we have. The risk bucket, we are showing ultra conservative numbers of very low numbers like 6% when the managers are averaging over 3 times that. And then the last one, number 5, is downsize. Most of our clients When they get into their late 70s, early 80s, they'll sell the home. They'll go into a retirement community. They'll sell the home for X. They'll buy a condo for Y. X is much larger than Y. And there's an injection of capital there that we don't account for, which is icing on the cake. All 5 of those things are key math-based solutions to fight inflation. So inflation is there. Our clients have an answer for it.
Okay, just a couple minutes left in this segment. We're going to talk more about some of the challenges facing retirees on this edition of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Now, you know I don't come from the investment world. I don't come from the financial world. So I'm back to your bonds versus bond funds because I look at them the same. Obviously, they're not the same. Can you explain the difference between bond funds you're talking about that are not bonds, I guess?
Yeah, bonds or CDs have a specific maturity date. And if you bought a corporate bond, municipal bond, high yield bond, CD, anything with a specific maturity date, you can hold that to maturity and its price might go down between now and then, but it will accrete back to par and you get $1,000 per bond or per CD when it matures. That's an individual, a straight bond or a CD. A bond fund does not have a maturity date. It is a fund of different bonds with different maturity dates, but people buy into this portfolio and they sell or buy whenever they want. It's liquid to them. But that's a fluctuating portfolio where that value drops when interest rates go up and goes up when interest rates go down.
So I'm 63. You'd think I know this, but I don't. I've never been in the financial world. And I know for most of you, that was probably a dumb question. So I apologize. But I think for some of us, maybe that was good information. I don't know. Depends on where you are, I suppose. Here's the deal. If you're talking about retirement, and are you on the right track? Can I retire? Well, when can I retire? Do I have enough? Will my money last as long as I do? Will my loved ones be okay if something happens to me? Big questions. Brian and the team at Decker Retirement are here to help. Again, it's 833-707-3030 is the number. No cost for this, no obligation, no pressure. 833-707-3030. If you've already won the game, Brian and the team will tell you, hey, you don't need our help. You've done a great job. Keep doing what you're doing. Or maybe it's, hey, we could move something over here, tweak this over there. Boy, you're going to be in great shape. Or maybe they can't help you. They don't know any of that until they sit down with you. 833-707-3030. We're talking about some of the challenges facing retirees. More with Brian J. Decker of Decker Retirement Planning right here on Safer Retirement Radio right after this.
As the weather warms, the open roads begin to beckon. If you've been getting the itch to travel, call Brian at 833-707-2020 to make sure you have enough saved to keep the winds of adventure blowing in retirement.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, you can always go to the website to learn more. You can even pick up Brian's book on retirement, the Decker Approach book, DeckerRetirementPlanning.com to find out more about Brian and the team. But you can also go to that heading under Decker Retirement Planning, Safer Retirement Education, to pick up anything that you would like to help you on your trek to retirement. It's just there for your information. Of course, you can always call if you want to chat with them. To me, that makes the most sense. Let's find out where we are. Am I on the right track? Do I need to tweak here or there? I don't know. Help me, Brian. 833-707-3030. There's no cost. There's no obligation. 833-707-3030. We're talking about some of the challenges that folks will play. It's a really difficult time to retire when the markets aren't booming. If we would have retired in, say, April of 2009, the markets were going to do nothing for the next decade but go up. Great time to retire. But now it's kind of that murky time. Just like if you retired at the end of 99, then the next decade was the lost decade on the market. So a lot of moving parts, and you can't control the markets, but you can control a little bit if you have a plan, you have a strategy, and that's what Brian and the team are here to help you with. And you think about it, most people come in to you, Brian, and they go, hey, I've got a plan, Brian. I got a 401k, I got a little pension at work, I've got some life insurance, I got some real estate, I got some IRAs. I mean, I got tools in there. The tools are important, but they're not a plan. It's kind of like the pie chart that you would get from, your broker versus distribution planning that you create for your clients. Those are two totally different things, aren't they?
Correct. So having all those different pieces is like having some lumber and some cement and some rebar and some copper and some windows and it really is just lying on the ground. It really doesn't do anything until you put it all together in a plan.
So is that like getting all the lasagna ingredients and setting it on the counter, but I don't have lasagna yet because I still got to put it all together?
That's another great analogy. Yeah, you've got to put it all together in a plan. The pie chart is an asset allocation pie chart is a description of how you're diversified in your current investments. It's not a retirement plan. You can't look at a pie chart and tell how much income you can draw for the rest of your life. You can't look at a pie chart and see if you have too much or too little risk. You can't look at a pie chart and do income planning. You can't look at a pie chart and see how much Roth conversion that you should do each year. So a pie chart has produced two huge problems for people over 65. Number one, the biggest fear of people over 65 right now is running out of money before they die, because they cannot, no matter how smart you are, you cannot look at a pie chart and see how much money you can draw for the rest of your life. Number two is the second biggest fear of people in retirement are these market crashes that typically roll through in a market cycle every 7 or 8 years. So last year, 2022, there was a big drop of 19% in the S&P, 33% in the NASDAQ, 20% in bonds. And people in retirement thought they were safe when they diversified. Well, that was a big hit. That was a big surprise. And so we're going to get to two different parts to that when we talk here in a few minutes. But the first thing here is to have a plan. Now, some people will push back, some advisors, and say, no, we have a plan. We use the 4% rule. Well, the 4% rule is where stocks have averaged around 8% for the last 100 years. Bonds have averaged around 4% for the last, 40 years. So now let's just take 4% to be conservative from your portfolio for the rest of your life, and you should be fine. Well, two problems with that. We talked about being in a flat market cycle where historically we're looking at 10 to 15 years of zero returns for stocks. And we're in an environment with bonds where the Fed has 2 more rate hikes, and then interest rates are expected to roll over. In a low interest rate environment, you're not getting 4%. You are right now, but probably not in the next 3 or 4 years. And so that's a problem for people using the 4% rule. But the bigger problem is called sequence of returns risk. So Mark, let's say that you retired January 1 of 2000, you have $2 million, boom, you pull the plug and you're gone. And you pull 4% per year. Well, the problem is markets are down in 2000, 01, and 02, down 50%. But you're down more than that because you're pulling 4% a year. You're down 62%. That's the bad news. The good news is markets come back 03 to 07, markets double, but you don't get all that because you're pulling 4% in 03, 04, 05, 06, 07. 4 times 5 is 20%. And so then you take the hit in 2008, down 37%, actually down 50% again from November of 07 to March of 09, and then plus your 4%. And that's why millions of people threw in the towel, and they showed up by the millions at fast food, banks, Walmart greeters, back in retail. They had to go back to work, plan B. They had to sell their home, move in with the kids, because the 4% rule really hurt them. In fact, the guy who invented the 4% rule has come out in 09 and saying that you need markets to be trending higher for this 4% rule to work. And there's another tool that's used called the Monte Carlo simulation. Well, Monte Carlo will tell you that you have a 90% probability of having a good retirement. Well, I hope you sleep well at night knowing that 10% is called tail risk. That's the black swan events that the markets have every 7 or 8 years. And so when you have those hits, you have on your charts the Monte Carlo showing you your $2 million portfolio going up every year. That is unrealistic. That's not going to happen. There's going to be ups and downs in the market going forward. Again, historically speaking, we have a flat market cycle that we're looking ahead. But a pie chart, and the bottom line point here is the pie chart is not a plan. So in contrast to that, we are fiduciaries, we're math-based, so you would expect that we would have in our distribution plan, it is a spreadsheet. So it shows, Mark, it shows you with your name, it shows your age. We plan to age 100. We don't think you'll live that long, but if you do, we want to make sure your money outlives you. And we show all your sources of income, Mark. We show your Social Security, we show your pension, we show your rental real estate, and then we show your portfolio income. We total them up, that's gross income, minus taxes. That gives annual and monthly income with a COLA, cost of living adjustment, to age 100. We show our income. We have a plan. That is a retirement plan. And then on the right side of the spreadsheet is the different buckets. Every retiree has 3 parts to their bucket. They've got cash, money, and risk. Well, on their cash, they've got emergency cash. Everyone has their number. It's different for everybody. But that emergency cash is liquid money that's available in there for any kind of emergencies. Your car goes down, your water heater, your roof needs to be replaced, whatever it is. You've got that emergency cash there. And then you've got buckets 1, 2, 3, 4, and 5. Bucket 1 is a cash account that pays out for the first 5 years. Bucket 2 and 3 are principal guaranteed fixed rate investments. Bucket 2 is a 3-year, bucket 5 is a 5-year, and then buckets 4 and 5 are 7 and 10-year principal guaranteed accounts with variable rates averaging about 8.5%. So here, before I get to the risk bucket, I just want to say that when you retire, you want 2 things. You want your income, because that's replacing your paycheck, and you want to backfill what goes out of your portfolio. For the next 20 years, we have 75% of the money coming back to you as income. And then we carve out about 25% of the portfolio, and that's going to grow for 20 years, and that is there to replace what's been paid back to you. Over 20 years, that 25% grows and replaces what you've taken out. It's like shifting so that the second half of your retirement, the next 20 years, that money is there to pay out. But here's a key point, 2 key points actually. One is when you draw income from fluctuating accounts, mathematically, you compromise gains when markets go up and you accentuate losses when markets go down. That is what happens when you draw income from a pie chart or a fluctuating account where all your money's at risk. You've got your stocks, bonds, you've got your gold and your other accounts. All your money's at risk. When you draw income from fluctuating accounts, it works until it doesn't. And when it doesn't, you go back to work. Not our clients. Our clients are drawing from laddered principal guaranteed accounts. Laddered principal guaranteed accounts. So like last year in 2022, when bond funds were down 20%, our clients lost nothing. They didn't lose anything in their buckets 4 and 5. And their buckets 1, 2, and 3 were laddered accounts that pay out like CDs, a rate. So our clients are able to make money whether the markets go up or down. That's point 1, is we want to make sure that we are drawing income from laddered principal guaranteed accounts. Our clients have tremendous peace of mind, Mark, that they will stay retired whether the market trends up, which we will participate in, and when the markets trend down, we don't take those hits. So that's critically important. The second point is we use compounded returns in our favor. So we do that by drawing from the lowest earning accounts, allowing the higher earning accounts to grow and compound and more than offset what we've drawn from those client accounts over a 10 or 15, 20-year period. That is using compound interest in our favor. So those two key parts are part of the distribution planning that we use. So on this distribution plan, here's what we're able to do. We're able to do income planning. Where are we on the tax planning? Where are we on the marginal rates? Are we just heading into from 24 to 32%? We don't want to be in 32%. If we can't, we can avoid it. We do income planning to let our clients know of where we are and where we want to be, and have strategies in place so that we can make sure that our tax planning, our strategies are helping our clients. We use two huge tax strategies with almost everyone. One is tax deferral. So we want to make money, but we want to push out the taxable gains until we pull them as income. And the second is the Roth conversion. I'm going to spend a lot of time on the Roth conversion later. But on the plan itself, it allows us to do portfolio planning on one spreadsheet. It allows us to do income planning, tax planning, risk reduction. We look at fee minimization. All of that is all done from a distribution plan.
So if you'd like to learn more, how does this all impact you and your retirement? Do you have this type of a plan when it comes to your retirement? The number is right around 20% of people actually have a retirement plan. Most are kind of going, I think I've got enough, I hope I've got enough, and just kind of doing it on their own. And they're really thinking it's all about investments. Well, it's not. Retirement planning is about income, about investment, taxes, healthcare, legacy planning. What about Social Security? It's in the income part. What about Medicare? It's in the healthcare part. There's a lot of moving pieces, and that's what Brian and the team at Decker Retirement will walk you through your specific situation. It's about you. Everybody's situation is unique. The tools you need may be different than the tools your relatives need or your neighbors need. The amount of income is going to vary. Some need 20 grand a month. Some will be fine with 3 grand a month. Everybody's situation is unique, and that's how Brian and the team look at it. If you'd like to learn more about where you are on that road to retirement, just give the team a call. There's no cost, there's no obligation, there's no pressure. 833-707-3030, 833-707-3030. Great time to do it right now. 833-707-3030. Back with our final segment of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this.
We all want the freedom to do the things that make us happy, especially in retirement. To get help with laying the foundation for that freedom, call 833-707-2020 to have a chat with Brian. What if you ordered a pizza, but when you opened the box, a couple of pieces were missing? That would be upsetting, right? Now, think about how much you believe you've saved for retirement. Do you still owe taxes on that money? Brian Decker and his team at Decker Retirement Planning understand the importance of tax planning and can help you reduce the impact that Uncle Sam has on your retirement. Give them a call today to start working on your retirement tax plan at 833-707-3030. Now may be a great time to lower your future tax liability. Create a retirement plan today so that you can get as many slices of your retirement pie as possible. Give Brian Decker a call at 833-707-3030 and schedule a visit. That's 833-707-3030. Firm offers insurance services and may not give tax advice. Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, you can always go to the website to learn more about Brian and the team, DeckerRetirementPlanning.com. You can also go there under the heading of Safer Retirement Education. You could download Brian's book on retirement, the Decker Approach book, 3 Principles of Retirement book, Checklist Challenge, and then a sample income plan. That's 4 of the 12 different things you can download right there on the website, DeckerRetirementPlanning.com. And of course, you have questions. You want to really go, hey, Brian, I want you to help me figure out where I am on that road to retirement. 833-707-3030, 833-707-3030. All right, final segment, Brian. You've already covered a lot of ground, but I know you're going to get into a little bit more of the tax world in this segment. Where else are you going?
We're going to cover Roth conversions, and we're going to cover the risk side, the risk strategies. So if we are true fiduciaries to our clients, Mark, and we're a math-based firm, here's what we would never do. Hey, Mark, here's 5 different mutual funds. I'm sure there's better out there, but let's use these. These will do. How would you feel if I said that to you?
Well, if they would actually do, I would be okay. But they're probably not really going. There's probably better tools for me, I would think, the way you worded that. Yes.
Right. So what we want to know is we want to put in place the best performing risk managers that we can find. And by the way, we do this also we use a database that lets us see what the highest earning principal guaranteed accounts are for our clients on the principal guaranteed side. So our money markets are right now earning 4.85%. Our 3-year is getting 5.5%. Our 5-year is getting 5.75%. And our 7 and 10 years are averaging about 8.5%. So we know what the highest earning principal guaranteed accounts are for cash, 1 to 3 year, 3 to 5, 5 to 7, and 7 to 10 year principal guaranteed accounts. Well, we do the same work on the risk side. We go to the databases. The Wilshire database is the largest database of money managers in the world. We go to the Morningstar database, largest database of mutual funds in the world, and 3 others. And each quarter, we have 4 requirements for any manager that manages money for our clients. Number 1, they have to have gone through a down market. Now, that's easy because last year happened, so now almost everyone has. But I want to see proven results as they've gone through a down market and done well in protecting capital. Number 2, they have to show actual numbers, no hypothetical or back-tested numbers. Number 3, the manager has to show their numbers net of all fees. And number 4, this is the most important, they have to show third-party verification on all of it. So we gather the data each quarter, and we have 4 filters for the managers that we look at. Number 1, we get rid of managers that are closed to new investors. We're not taking any new clients. Number 2, we get rid of the hedge funds because of their volatility. Number 3, we get rid of managers with per account minimums of $4 or $5+ million. Number 4, we get rid of managers that are high beta. In the good years, they go way up. In the bad years, they go way down. What is left when we look at our data? What is left for last year, the last 10 years, the last 25 years, Mark? Would you be surprised if I told you that the best performing managers for all that period are all computer models? Would that surprise you, Mark?
Nope. It's AI's taken over is what you're saying, isn't it?
Yep. Well, this is before AI. AI is taking over, but computer algorithms have been beating individual managers like you and me because we have fear and greed. We have human nature that really hurts us in managing money. Fear keeps us from buying when we should. Greed keeps us from selling when we should. So computer algorithms don't have those. And so we have basically 2 different types of risk managers. One is trend following, where when the trend of the market is up, you're invested in the markets. And when the trend of the market is down, the computer algorithm moves you to cash so that you don't take those hits. That's one kind of computer algorithm that we use. Number 2 is we also use relative strength type of investing, which means that we buy whatever is going up. We have one manager that's in over 25 different markets. He can make money in markets that are going up or down. He's in currencies, he's in commodities, he's in stocks and bonds. He's very well diversified, and average annual returns are over twice what we show on our plan. So we always like to be conservative, Mark. So for example, on our risk account, we have 6% when they're earning much more than that. On our bucket 1 in cash, it says 1% when we're getting almost 5%. And same thing throughout. We want to be very, very conservative. But on our risk portfolio, this is where we are highly recommending clients have active money management, because if history repeats and we have entered a flat market cycle, a buy and hold strategy of stocks, individual stocks, ETFs, or mutual funds is not going to make money in the next 10 to 15 years if history repeats. There's been 4 times that the S&P has traded above a valuation of 30 times trailing earnings. One was 1929. It took 17 years to get your money back. The second was 1964. It took 18 years to get your money back. The third was November of 1999. It took 14 years to get your money back. And the fourth was November of 2021. We traded at 32 times earnings. And so we expect that the markets are going to be trading flat, up and down, for the next 10 to 15 years. Active money management is what in that environment is going to do well, that protects you when the markets go down, has you invested when the markets are going up. Mark, last thing I want to talk about is the Roth conversions. In my opinion, this is the last big tax saving strategy, and it's available for most everyone. So what we want to do is we want to give you that growth and have it be tax-free. A Roth account is 3 things. It grows tax-free, it distributes income back to you tax-free, and it passes to your beneficiaries tax-free. That account is wasted if you put it in a money market account or in CDs. The returns are too low and you're taking the money too soon. We want it in the longest earning account with the highest return. So we put that in our risk bucket. We know mathematically how much money should be converted from IRA to Roth. We know to the dollar how much money. If you ask your advisor, not so much. Well, whatever you want to convert. And there's a right and wrong way to do the conversions. So what we do is we look at the client's gross income. We take out the standard deduction or any itemization to get an AGI, adjusted growth. We see how much headroom there is, which is room between where your AGI, your adjusted growth income is, and we keep you in the same tax bracket, unless it's 22 to 24. We just want to keep our clients out of the 32% bracket mark. And so we see how much we can convert each year. And ideally, we want to have everything converted before January 1 of 2026. Why? Because that's when the Trump tax cuts sunset. And that's when we expect that rates will be going up for everyone January 1 of 2026. So we have 3 more years to take advantage of Roth conversions before we see what we're dealing with higher tax rates. Roth conversions are very important for our clients' risk because we are helping someone grow their money tax-free. There's 32 trillion reasons why we believe that tax rates will be going much higher. That's the value of the budget deficit right now. Tax rates, we think, have to go higher to handle the huge budget deficits that we have to pay, our generation and all the future generations. So with tax rates going higher, we want to have our clients have at least one tax-free growth account that will provide tax-free income in the second part of their retirement. So Mark, those are the key things that we look for in retirement planning. And we actually sum them up. If people want to write this down, 6 key parts to a retirement plan. 1 is to have a plan. We talked about that today. 2 is comprehensive tax minimization strategies. Number 3, risk reduction. You shouldn't have a 60, 40, 70, 30 plan in retirement. You can't replace those funds when you retire and the markets go down 30, 40%. Number 4 is income optimization. Number 5 is portfolio optimization, making sure that every account is getting the best return possible. And then number 6 is fee minimization. Our typical client pays about 60% less in fees than the regular advisor.
So I think you can tell just from listening to Brian on the radio that he really loves educating retirees on their investment options that make sense for them, because it is about you. Remember back when we started, the fiduciary standard, legally, morally, ethically obligated to do what is in the client's best interest. That's the advisors at Decker Retirement in the market world. And then in the insurance side, it's the suitability standard, where obviously it's got to make sense or they're not going to bring it up. But everybody's unique, and that's how Brian and the team look at it. They're really here to offer you that alternative to the old buy and hold recommendation that you get from bankers and brokers. So Brian has created several investment models and has honed his managerial risk skills, if you will, with a focus on investment models designed to make money in up or down markets. It's a moving target all the time. Brian and the team are here to help. If you would like their help, they would love to see if they can help. Maybe you've already won the game. You don't need their help. Maybe you do need their help and you don't even really know it. What a great opportunity to talk with Brian and the team at Decker Retirement. 833-707-3030, 833-707-3030. Again, no cost, no obligation, no pressure. 833-707-3030. Brian, enjoy the rest of the weekend. Have a great week. We'll talk again next week.
All right. Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.